Welcome to the deep dive. Today we're tackling a really interesting subject, the 2024 annual report from Jardine Matheson.
Yeah, it's a big one.
Yeah.
A conglomerate with, well, a huge footprint across Asia, isn't it?
Exactly. They're involved in so much: cars, property, hotels, retail, you name it.
Mm-hmm.
So think of this as your guide to understanding how they did recently, what their game plan is, and, where they're headed.
Right. The mission, if you like, is to pull out those key business and financial nuggets from the report.
Yeah, give you a clear, concise picture of where Jardine stands and how they're planning to create value for shareholders. Let's dive in.
Okay, let's do it. So Jardine Matheson, its strength, maybe its complexity too, is this really diverse portfolio. We're talking about 6 main business segments.
6? Okay, let's break those down.
First up, you've got Astra in Indonesia. They are, well, the #1 automotive group there, big in heavy equipment distribution, financial services too, a real powerhouse.
Astra, right. Got it. What else?
Then there's Hong Kong land. Think flagship properties, prime real estate in places like Hong Kong, Singapore, Shanghai. Very high-end stuff.
Landmark buildings, often.
Okay, then Jardine Pacific. This one's a bit more of a mix: engineering, construction, air cargo handling, some automotive distribution, even restaurants.
Bit of everything in that one.
Sort of, yeah. Then DFI retail. That's your supermarkets, convenience stores like 7-Eleven in some places, health and beauty, home furnishings, Guardian, cold storage, IKEA in some markets.
Familiar names there. And number 5.
Zhongsheng. They focus on luxury car dealerships, primarily in mainland China. Think brands like Mercedes-Benz, Lexus, Porsche. A very specific market.
Luxury autos in China.
And the last one.
And finally, Mandarin Oriental, the global luxury hotel group. Very well-known brand. So quite a spread, geographically and by sector.
It really is. And if you look at where the profit actually came from in 2024, the underlying profit,
yeah,
it tells a story.
Where did it come from?
Indonesia was huge, 48%. That just underlines Astra's importance, doesn't it?
Almost half. Yeah. Hong Kong and Macau together chipped in 26%. Mainland China was 9%, then other Southeast Asian countries 7%, Vietnam 5%, and the rest of the world the final 5%.
So heavily weighted towards Asia, especially Indonesia and Hong Kong, Macau.
Definitely. And if we look at which segment drove the underlying net profit, again, Astra leads, 46%.
Makes sense given the geographic split.
Right. Hong Kong land is next at 22%. Then Jardine Pacific and DFI Retail, they're both around 9%.
Okay.
Zhongsheng, the China car dealerships, 5%, and Mandarin Oriental, 4%. You just can't ignore the impact of Indonesia.
No, absolutely not. And what's really interesting, I think, is the strategic thinking going on within some of these segments.
How so?
Well, they've appointed new CEOs at Hong Kong Land, DFI, Mandarin Oriental, and Jardine Pacific recently. And apparently these new leaders have kicked off some pretty deep strategic reviews.
New broom sweeping clean.
Sort of. The main goal seems to be finding clear ways to grow long-term and, deliver better shareholder value. It sounds like more than just minor adjustments in some cases.
Like with Hong Kong land, their shift seems quite significant.
Exactly. They're really zeroing in on these ultra-premium integrated commercial properties, think high-end office and retail combined in key Asian cities.
And they're pulling back from build-to-sell residential.
Yeah, they're stopping new investment there. The idea is to recycle that capital back into their core commercial property strategy. Although their West Bund project in Shanghai did have strong luxury residential sales, so maybe not abandoning it entirely, just shifting focus.
Doubling down on being the landlord for prime commercial space, it seems.
Precisely. And Mandarin Oriental, they've got some pretty big plans too.
Oh, yeah.
They're aiming to basically double their hotel portfolio by 2033.
Double? How?
Mostly by growing the management side of the business, which doesn't require owning the buildings,
Yeah.
less capital intensive. And also selling off some owned properties to raise cash, like they sold the Paris Hotel for, what was it, US $382 million.
The asset-light model. Makes sense for faster expansion.
Then you've got Astra back in Indonesia. They talk about their Triple P roadmap.
Triple P.
Portfolio, people, and public contribution. Their vision is literally to be the pride of the nation in Indonesia.
Wow, that's quite an ambition.
It shows how deeply rooted they are there. And like we said, #1 in key sectors, and they're pushing into digital banking now too, looking for those future growth engines.
Okay. And DFI Retail, any big strategic moves there?
Yeah, they've also been reshaping their portfolio driven by shareholder value. They sold off the Hero supermarket business in Indonesia and the giant hypermarket chain in Malaysia.
Streamlining then. Is it working?
Well, the report says 2024 saw an improvement. They gained some market share and kept costs under control. So, yeah, it seems like those moves are starting to yield results.
Okay, good context on the businesses and strategies. Let's shift gears to the overall financials now. How did the group do as a whole in 2024?
Well, the headline is resilient performance despite headwinds. But the underlying net profit did actually fall.
Oh, by how much?
It was down 11%, coming in at US $1,471 million.
Okay, so a dip, but you said resilient.
Yeah, because as we discussed, Astra was strong, DFI recovered well.
Yeah.
That helped offset lower contributions from Zhongsheng in China and also Hong Kong land.
Right. And underlying net profit is key. It tries to show the core operational performance, stripping out unusual items.
Exactly. And understanding why those segments were lower is important. Zhongsheng, the luxury car dealer, faced a tough new car market in China. That makes sense.
And Hong Kong land.
Partly due to planned mall renovations that hits rental income short term, but also just a softer environment in mainland China generally. It shows the mix of challenges they face.
Okay. What about the top line, the revenue?
Group revenue was US $35.8 billion. That's actually slightly less than the year before.
Why was that?
Mainly because of those disposals we mentioned, like a DFI, and also currency effects translating foreign earnings back into US dollars.
Ah, the currency headwinds.
Right. But if you look at their ongoing businesses and adjust for currency, revenue actually grew by 3%.
Okay, that paints a slightly different picture. Any specific segment revenues worth noting?
Hong Kong Land's revenue was up 9%, driven by property development. Astra was flat year-on-year in reported terms, but up 5% if you exclude currency effects, with financial services doing well.
And DFI?
Their revenue was lower, but that reflects the divestments and also weaker convenience sales in Hong Kong, apparently.
Got it. And you mentioned the profit split earlier, heavily Southeast Asia.
Yeah, 66% of group profit from Southeast Asia, mainly Indonesia, of course, and 28% from Greater China. It really highlights where the current strength is versus the pressures in China.
Okay. Let's talk shareholder returns. Earnings per share, or EPS.
Underlying EPS decreased a bit. It was US 33.15 in 2024, down from US 34.44 in 2023.
So earnings per share down, but what about dividends? Did they cut them?
No, actually the opposite. Dividends per share DPS increased, went up to US 23.000000 for 2024 from US 22.0 the year before.
Interesting. Raising the dividend even when underlying profit and EPS fell slightly?
Yeah, it often signals management's confidence in future cash flows, and a commitment to returning cash to shareholders.
Makes sense. Where did they put their investment capital in 2024?
Total capital investment was pretty chunky, US $8.7 billion overall.
Wow. Where did most of that go?
The biggest chunks went to Hong Kong land, over US $3 billion, and Astra, which got about US $1.8 billion, gives you a sense of their priorities for future growth.
Right. Now, the balance sheet, how's the debt looking?
Net borrowings, and this excludes Astra's financial services arm, which is different, increased a bit, went up to US $8.4 billion from US $7.5 billion.
Okay, more debt. What about equity?
Total equity decreased slightly to US $53.3 billion from US $55.9 billion. But importantly, they had plenty of financial flexibility.
How so?
They had US $7.3 billion in undrawn, committed credit facilities, basically, available loans, and almost US $5 billion in cash and liquid funds at year-end. So a decent cushion there.
Good to know. And they were selling assets too, right?
Yeah.
Generating cash.
Yeah, back in 2023, they raised over $1 billion from disposals. Things like DFI properties, a UK car dealership, part of an Astra Financial Services investment, and their stake in a packaging company. Shows they're actively managing the portfolio.
And share buybacks, did they do any of that?
They did. The company bought back US $101 million of its own shares in 2024.
Okay. Less than the year before, though.
Yeah, it was US $209 million in 2023. But interestingly, they also spent quite a bit buying shares in their subsidiaries, Jardine Cycle and Carriage and Mandarin Oriental, over US $700 million combined.
Strategic moves within the group structure, perhaps.
Could be. So putting this all together, what are they actually saying about creating shareholder value? What's the plan?
Well, the report is pretty explicit. Their main purpose, they say, is delivering superior long-term returns to shareholders. Pretty standard, but good to state clearly.
Sure. How do they plan to do that?
It seems to boil down to a few key things. First, building bigger, stronger businesses in their portfolio. The focus is on generating high-quality, sustainable growth in earnings and cash flows.
Cash flow is king, right?
Exactly. And crucially, driving returns on the capital they invest that are higher than their cost of capital. Actually creating value, not just growing for growth's sake.
That WACC hurdle. Makes sense.
Ultimately, they want superior growth in net asset value per share and continued growth in the dividend like we saw this year.
So the dividend increase and the progressive policy are central to that value proposition.
Seems so. And the share buyback program, even though it was smaller last year, still plays a role by reducing the share count.
Right. And what about total shareholder return, TSR? That combines the share price movement and dividends. How does that look?
It's a bit of a mixed bag looking at the report's figures. The 1-year TSR was 5.5%, 5-year was 5.2%, the 10-year looks better at 13.5%.
On a longer term.
That's where it gets less impressive. The 15-year and 25-year TSR figures were actually negative.
Reflects some tough periods or market cycles, I suppose.
Must do. The report does point out that DFI Retail's TSR improved in 2024 thanks to its better performance, while Zhongsheng's TSR was dragged down by those China auto market issues. It really shows the diversity within the group.
Yeah, the overall number hides a lot of variation underneath.
Yeah.
And they mention aligning management incentives.
Yes, they emphasize having qualified boards and leadership teams whose incentives are tied to delivering that shareholder value. Accountability.
Good governance point. And the progressive dividend policy is clearly a cornerstone.
Definitely seems that way. Okay, so assessing the business moving forward. What's the overall takeaway? It sounds like challenging conditions, but different plans in place.
Yeah, I think that sums it up. They acknowledge the tricky economic climate, and obviously performance is varied across the different companies in the group.
But the focus now is very much on execution.
Exactly. Implementing those new strategies we talked about, really pushing for operational efficiencies everywhere, and also bringing sustainability more into focus, that's becoming crucial for long-term value.
Right, ESG factors and all that.
They've set some, quote, challenging financial objectives to drive growth and boost that PSR.
So they're not expecting an easy ride, but they have targets, and they're still evolving the portfolio.
Absolutely. Through those disposals and reinvestments, the goal is always higher long-term returns and capital appreciation.
And that Indonesian bedrock seems pretty solid.
Yeah, the resilience there provides a really strong foundation. Fundamentally, their whole approach seems geared towards being a long-term investor, focusing on sustainable earnings and cash flow growth.
That long-term perspective combined with actively managing all these different businesses and that clear commitment to dividends and smart capital use,
Yeah,
that's going to be key for them in Asia, isn't it?
for sure. Navigating the opportunities and the complexities there.
Well, this has been a really useful deep dive into Jardine Matheson's 2024 report. We've seen a company making some pretty big strategic adjustments across its, well, very diverse portfolio.
Yeah, responding to a changing world.
And the 2024 results show, strengths in some parts, challenges in others, but the plans for growth and shareholder value seem pretty clearly laid out.
Agreed. And it does leave you wondering, doesn't it? A question, maybe for you listening.
Go on.
Well, given these strategic shifts, the way they're moving capital around, what do you see as the biggest potential upsides and maybe the biggest risks for Jardines in Asia over the next few years?
Good question. Opportunities versus risks.
And also, how important will that increasing focus on sustainability really be? Will it genuinely drive their success and that shareholder value they're targeting? Something to mull over.
Definitely food for thought. Thanks for joining us on this deep dive.
Until next time.